All right, let's dive in. Today, we're breaking down the latest numbers from Marriott International. And this is more than just a financial report. It's a fascinating look at who's traveling, where they're going, and what they're spending in today's economy. So, let's get right to it.
Okay, so this really gets to the heart of it, right? If you're the largest hotel company on the planet, how on earth do you manage your business when the economy is kind of all over the place? Strong in some spots, weaker in others. Well, that's the puzzle we're going to piece together today.
And just to give you a sense of scale here, try to wrap your head around this number. Over 1.75 million rooms across the globe. The sheer size is just massive, and managing that is an incredible feat in itself.
So, we know they're huge, but the real question is, how did they actually do last quarter? Let's get into the nitty-gritty and break down the results. Here's what we're going to cover in this explainer. We'll start with their report card, the top-line numbers. Then we'll look at the big divides in their performance, dig into their loyalty program, check out their growth strategy, and finally, see what they're predicting for the future.
All right, first up, let's look at that Q3 report card. How did Marriott actually perform?
So the big headline, modest growth. But, and this is a big but, they actually did better than expected. You know, in an economy like this one, just beating your own forecast, that's a pretty solid win.
Now, before we get any deeper, we have to talk about one key metric. It's called RevPAR. That stands for Revenue Per Available Room. Basically, it's the ultimate health check for any hotel. It tells you how well they're filling their rooms and how much money they're making from each one.
So for the third quarter, Marriott's global RevPAR was up by 0.5%. And you might be thinking, 0.5%? That's it? But hold on, because that one little number is hiding two completely different stories.
And that brings us right here to a world of difference. Because when you really dig into the data, you find this major split in where all that growth is actually coming from.
And here is that split, plain and simple. On one side, international markets are just booming. People are traveling and growth is strong. But then you look at the US and Canada, and things have cooled off a bit, mostly because business and government travel has gotten a little weaker.
Wow, and when you look at the numbers, that difference is just stark. International growth is really solid, but check out the Asia-Pacific region, APAC, up almost 5%. That's a huge engine for them right now, and it's basically canceling out that small dip in North America.
But it's not just about where people are traveling. It's also about who is traveling. And there's another really important split here. High-end luxury travelers, they are still spending. They're proving to be really resilient. But the more budget-friendly brands, the ones that rely more on business travelers, well, that's where they're seeing a decline.
I mean, look at this, a 4% jump in luxury RevPAR. What that tells us is that even when the economy feels a little uncertain, the demand for those premium travel experiences is incredibly strong. And Marriott is perfectly set up to capture that spending.
So you have to ask, what's driving all this? What's their secret weapon? Well, a huge part of the answer comes down to their powerhouse loyalty program, Marriott Bonvoy.
The sheer size of Bonvoy is just mind-boggling. We're talking about nearly 260 million members. That's up 18% in just 1 year. It's way more than a loyalty program. It's this massive community of travelers.
And hey, you don't have to take my word for it. The CEO, Tony Capuano, said it himself on their earnings call. He said the value Bonvoy brings has grown exponentially. And here's where it gets really interesting. This isn't just about points for hotel stays. We're talking over $660 million in 1 year, just from the fees they get from their co-branded credit cards. It's an absolute money-making machine that has nothing to do with someone booking a room.
So, with all that cash coming in, what are they doing with it? Well, they're using it to build the future. Let's take a look at their strategy for growth.
Okay, so their game plan has a few key parts. First, they're signing deals for new hotels like crazy. A record pace, actually, with nearly 600,000 rooms in the pipeline. And a really smart move is that they're converting existing hotels into Marriott brands, which is a much faster way to grow. And then, behind the scenes, they're pouring money into a huge tech upgrade.
And here's something that really ties it all together. Remember that international growth story? Well, more than half of all those new rooms they're planning are located outside the US and Canada. They are doubling down on that global strategy.
All right, so let's wrap this up by looking at what's next. What does the company expect for the rest of the year?
So here's what the company is telling investors to expect. They actually see things picking up in the last quarter of the year, with RevPAR growth accelerating a bit. And for the whole year, they're on track to grow their total room count by almost 5%. That's a pretty confident outlook.
So if you boil it all down, what's the one thing to remember? It's all about being smart and resilient. In this really mixed-up global economy, Marriott's putting its focus, its energy, and its money on the two areas that are working best, those booming international markets and the high-end luxury traveler.
And that really leaves us with the big multi-billion-dollar question, doesn't it? As the world keeps changing, can this laser-focused strategy of relying on luxury and international growth keep working? That's the question Marriott is betting its future on. Thanks for joining me for this explainer.